And US investment banks are bracing for deeper job cuts as economic uncertainty weighs on deal making. Banks like Goldman Sachs, Morgan Stanley, JPMorgan and Bank of America have already started trimming staff, with further layoffs expected if deal activity does not pick up. Now, this downturn is reflected in investment banking fee, which fell 6.3% last year. The slowdown extends to equity offerings, with IPO issuance dropping to $57 billion from $69 billion in the same period last year. Analysts say large banks are leading the layoffs, with boutique firms likely to follow if the deal flow remains weak. Recruiters warn that if conditions don't improve by mid-year, banks will be forced to make deeper staffing cuts. Market uncertainty fueled by US tariffs and economic slowdown fears has dampened corporate confidence. Bankers say companies are reluctant to go public amid concerns over stock performance post-IPO. The slowdown threatens Wall Street's 2025 bonus pools. Meanwhile, bank stocks have taken a hit, with smaller firms suffering the most. US brokerage Oppenheimer has now revised its investment banking revenue growth forecast to 0%, a sharp reversal from its previous estimate of 32% growth. If deal activity remains weak, banks will need to cut costs through headcount reductions and lower compensation. As banks navigate a challenging environment, staffing decisions will depend on deal pipelines in the coming months. Recruiters note that firms are assessing whether to staff up for growth or run leaner operations. Certain sectors like private credit and technology continue to show strength. However, consumer, industrial, and construction-related businesses are expected to struggle. Goldman Sachs has maintained that recent job cuts are part of its routine annual review process, with Wall Street bonuses, hiring, and overall growth at risk. All eyes are on deal activity in the second half of the year.